How does SIPC protect investors in a brokerage account? Imagine you're about to start investing in the stock market and open a brokerage account. You might wonder what happens if the firm you choose runs into trouble. Well, that's where the Securities Investor Protection Corporation, or SIPC, comes into play. SIPC is a nonprofit organization created to help protect your investments if your brokerage firm faces financial failure. But how exactly does it do that? Let's find out. First, SIPC steps in when a brokerage firm that is a member of SIPC cannot return your securities or cash because of insolvency. It is important to remember that SIPC does not cover losses from market ups and downs or bad advice. Its job is to protect your assets if the firm itself fails financially. To be covered, your brokerage must be a SIPC member, which most reputable firms are. SIPC protects your stocks, bonds, mutual funds, and cash held in your account up to a total of $500,000. Out of this, $250,000 can be for uninvested cash that you are waiting to use for buying more securities. If your brokerage collapses and some of your assets are missing, SIPC works to recover and return those assets to you within these limits. When a brokerage firm fails, you need to file a claim with SIPC. They then team up with a court-appointed trustee to sell off the firm's assets and distribute the proceeds to customers. Usually, you will get back your securities and cash, or a proportional share if the full amount isn't recoverable. This process can take some time, but SIPC's goal is to get your assets back as quickly as possible. It's important to understand what SIPC does not cover. It does not protect against losses caused by the stock market falling or bad investment advice. It also does not cover commodities or futures contracts unless under very specific conditions. So, SIPC's main role is to protect your assets from the failure of the brokerage, not from investment risks. In the context of stock trading and options, SIPC protection is a safety net. It ensures that your holdings in stocks, bonds, and options are safe if the brokerage faces financial trouble. This means you can trade and hold securities with more confidence, knowing there is a backup plan for your assets. To sum up, SIPC protects investors by covering missing securities and cash if their brokerage firm fails. It offers up to $500,000 in total protection per customer, with a maximum of $250,000 for cash. Only SIPC member firms are covered, and it does not protect against market losses or fraud unrelated to insolvency. When a brokerage fails, SIPC acts through a court-appointed trustee to return your assets as quickly as possible. This protection helps keep your confidence high when trading stocks and options, knowing your investments are safeguarded even in tough times.